Something unusual just happened in the silver market again. The CME has changed the rules, and if you have watched the silver market for long enough, you already know that rule changes rarely happen during calm and stable conditions. They usually appear during periods of stress, volatility, or when something inside the system begins to break. This time is no different. The Chicago Mercantile Exchange, the institution that operates the COMEX futures market, where most of the world's silver price discovery happens, has adjusted the rules surrounding silver trading once again. For many casual observers, this may look like a routine administrative decision. Exchanges update risk parameters all the time. Margin requirements change. Contract conditions evolve. But experienced market participants understand that these rule changes can carry much deeper implications, because the CME sits at the very center of the global silver pricing mechanism.
When silver moves on financial markets, the price most investors see does not come directly from physical transactions between buyers and sellers of real metal. Instead, it comes from the futures market, where contracts representing future delivery of silver are traded by financial participants. These contracts allow traders to gain exposure to silver without ever touching the physical metal itself. A single futures contract represents thousands of ounces of silver, yet traders only need to deposit a fraction of the contract value as collateral. This system creates leverage, and leverage allows enormous volumes of silver exposure to change hands every day. On many trading days, the amount of silver represented by futures contracts being bought and sold can be many times larger than the amount of physical silver actually moving through the global supply chain. For the most part, the system works because the majority of traders never request physical delivery of the metal. They simply close their contracts or roll them forward into the next delivery period. As long as confidence in the system remains intact, the paper market continues functioning smoothly. But when stress begins to build inside the system, exchanges sometimes intervene. They raise margin requirements. They adjust risk controls. They tighten rules to ensure that clearing members can meet their obligations. And that is exactly what has just happened again. The CME has adjusted the margin requirements associated with silver futures contracts, effectively increasing the amount of capital traders must post in order to maintain their positions. At first glance, this sounds technical, but the consequences can be powerful. When margin requirements increase, leveraged traders suddenly need more capital to hold the same positions they held before. If they cannot provide that additional capital quickly enough, their positions may be forced to close. This process is known as forced liquidation. In simple terms, traders who were betting on silver with borrowed leverage may be pushed out of the market. Historically, margin increases have often been associated with sudden price volatility in the silver market. Sometimes prices fall as leveraged long positions are forced to liquidate. Other times, volatility increases dramatically as the market rapidly adjusts to the new risk environment. But the story does not end there, because margin hikes can have a second, less obvious effect. They can change the balance of power between financial traders and the physical market. To understand why, we need to look more closely at how the silver futures system interacts with the underlying physical supply. The futures market was originally designed to help producers and consumers manage price risk. Mining companies could hedge their production. Industrial buyers could secure future supply. But over time, financial trading activity became the dominant force in price discovery. Large hedge funds, institutional traders, and algorithmic trading systems now account for a significant portion of daily volume. These participants are not necessarily interested in taking delivery of metal. They are trading price movements. This means that the silver price can sometimes move based on financial positioning rather than the immediate reality of physical supply and demand. But when exchanges change margin rules during periods of rising volatility, they introduce a powerful new variable. Leverage begins to unwind, and when leverage unwinds, the structure of the market can shift rapidly. Some traders exit positions, others step in to take advantage of new opportunities. Liquidity temporarily thins as participants reassess their risk exposure. During these moments, the relationship between the futures market and the physical silver market becomes especially important. Because while financial traders can move quickly in and out of positions, the physical supply chain moves much more slowly. Mines cannot instantly increase production. Refineries cannot suddenly produce additional bars overnight. Industrial buyers cannot simply stop needing silver because the price fluctuates. Physical demand continues operating on its own timeline. And when the financial layer surrounding the market begins adjusting, the pressure coming from the physical side can become more visible. This is where the conversation about a potential silver squeeze begins to emerge, not because of speculation alone, but because the structure of the market may be changing. When margin hikes force leveraged traders to reduce positions, the amount of paper silver circulating in the future system can temporarily shrink. If that happens while physical demand remains strong, the balance between paper contracts and available metal becomes more important. And if enough participants begin asking the same question at the same time, how much physical silver actually exists relative to the contracts trading against it, the market can begin behaving in unexpected ways. That is why rule changes at the CME are always worth watching carefully. They rarely appear without a reason. And when they arrive during periods of heightened interest in the silver market, they can signal that the underlying system is experiencing more pressure than it might appear at first glance, which raises the next critical question. What exactly happens inside the silver market when margin hikes begin forcing leveraged positions to unwind? To understand why margin rule changes can reshape the silver market so quickly, you first need to understand how leverage works inside the futures system. When traders enter a silver futures contract on COMEX, they are not required to pay the full value of the silver they control. Instead, they only need to post a percentage of that value as collateral. This is known as margin. For example, a standard silver futures contract represents 5,000 ounces of silver. If silver is trading around $86 per ounce, that single contract represents more than $430,000 worth of metal. But the trader does not need to deposit $430,000 to control that contract. They may only need to deposit a fraction of that amount as margin. That leverage allows traders to control large positions with relatively small amounts of capital, and that is exactly why futures markets attract so much speculative trading. Leverage magnifies both gains and losses. If silver rises sharply, leveraged traders can generate large profits relative to the capital they committed. But the opposite is also true. If silver moves against them, losses can accumulate very quickly. That is where margin adjustments come into play. When exchanges like CME raise margin requirements, they increase the amount of capital traders must post in order to maintain their positions. Suddenly, positions that once required a certain amount of collateral now require significantly more. For traders operating with heavy leverage, this can create immediate pressure. They must either deposit additional capital or reduce their exposure. If they cannot meet the new requirements in time, the clearing system forces the position to close. This forced exit can trigger rapid selling or buying depending on the direction of the positions involved. Historically, margin hikes have often been associated with sudden price volatility in the silver market. One of the most famous examples occurred during the silver rally of 2011. As silver surged toward $50 per ounce, the exchange implemented a series of margin increases within a short period of time. Each increase forced leveraged traders to commit more capital, and many were unable to maintain their positions. The result was a cascade of forced liquidations. Silver prices fell sharply in a matter of days as leveraged longs were pushed out of the market. But what many investors fail to recognize is that margin increases can create two very different outcomes depending on the structure of the market. If the majority of leveraged positions are bullish, margin hikes can trigger rapid price declines as those long positions are forced to liquidate. But if the market is heavily positioned with short sellers, traders betting that silver prices will fall, the dynamic can become much more complicated. Because short sellers also operate with leverage. When a trader sells a silver futures contract short, they are essentially borrowing exposure to silver and betting that the price will decline. If the price does fall, they can buy back the contract at a lower level and capture the difference. However, if the price rises instead, the short seller begins losing money. And unlike long positions, where the maximum loss is limited to the amount invested, short positions carry theoretically unlimited risk. As the price rises, losses can continue growing. This means short sellers must also maintain margin in their accounts. If silver begins rising rapidly and margin requirements increase at the same time, short sellers may face a difficult situation. They must deposit additional capital to maintain their positions, or they must buy back their contracts to exit the trade. That process is known as short covering. And when large numbers of short sellers attempt to exit positions simultaneously, the market can move violently upward. This is the mechanism behind what traders call a short squeeze. In a short squeeze, rising prices force short sellers to buy back contracts in order to limit losses. Their buying pushes prices even higher, which in turn forces more short sellers to exit positions. The cycle feeds on itself. Prices rise not only because buyers want silver, but because short sellers are forced to buy it. And when leverage is involved, the speed of the move can become dramatic. Now consider what happens when margin hikes occur during a period of increasing attention on the silver market. Leverage begins unwinding. Some traders exit positions voluntarily. Others are forced out through margin calls. Liquidity temporarily shrinks as participants reassess risk. During this process, the structure of positions inside the futures market becomes extremely important. If the market contains a large number of short positions betting against silver, rising prices combined with higher margin requirements can create exactly the kind of pressure that triggers a squeeze. This is why experienced silver traders pay close attention to rule changes from the CME, not because the rule change itself determines the price, but because it alters the financial mechanics of the market. Leverage is reduced, risk tolerance shifts, participants reposition themselves, and when those adjustments occur while the physical market remains tight, when industrial demand continues pulling metal out of the supply chain, the future system can suddenly begin reflecting pressures that were previously hidden beneath layers of financial leverage. This is where the conversation about a potential silver squeeze becomes more serious. Not because someone decides to engineer it, but because the structure of the market may naturally lead in that direction. And the most important factor in determining whether that happens is not the margin rule itself. It is the relationship between paper silver contracts and the physical silver available to deliver against them. To fully understand why rule changes at the CME can trigger conversations about a potential silver squeeze, you have to look beyond the futures contracts themselves and examine the relationship between paper silver and physical silver. Because the silver market operates with two very different layers. The first layer is the physical market. This includes the actual mining of silver, the refining process that turns raw ore into bars, and the distribution of those bars to industrial users, investors, and bullion dealers around the world. Physical silver moves through supply chains that involve transportation, storage, manufacturing, and delivery. The second layer is the financial market. This is where futures contracts, options, derivatives, and other financial instruments tied to silver are traded. These instruments allow participants to speculate on price movements or hedge risk without necessarily taking possession of the metal itself. In theory, the financial market exists to support the physical market. But in practice, the scale of trading activity in the paper market has grown enormously over time. On many days, the total volume of silver contracts traded on exchanges like COMEX represents hundreds of millions of ounces of silver changing hands. Yet the amount of physical silver actually stored in exchange vaults is only a fraction of that number. This imbalance is often described using the concept of leverage. Analysts sometimes estimate that the ratio of paper silver contracts to physical silver stored in the COMEX system can reach levels far higher than most investors realize. For example, if futures contracts representing hundreds of millions of ounces are circulating in the system, while vault inventories contain far less metal available for delivery, the ratio between paper claims and physical supply can become extremely large. Under normal conditions, this is not necessarily a problem. Most traders have no intention of requesting delivery. They are simply trading price movements. When a contract approaches its delivery date, they close the position or roll it into a later contract. But the system relies heavily on confidence. Participants must believe that the contracts ultimately represent real metal if delivery were ever requested. If that belief weakens, behavior inside the market can change. More traders may choose to stand for delivery instead of rolling their contracts forward. Industrial buyers may decide to secure physical supply earlier than usual to avoid potential shortages. Investors may begin accumulating physical silver rather than paper exposure. Each of these actions increases demand for actual metal. And when that happens, the exchange system must source silver from its available inventories. COMEX vaults categorize their silver inventories into two main groups. The first is registered silver. Registered silver refers to metal that has been specifically designated as available for delivery against futures contracts. This silver sits in approved vaults and can be transferred to contract holders if delivery is requested. The second category is eligible silver. Eligible silver is also stored in exchange-approved vaults, but belongs to private owners who have not designated it for delivery. While this metal technically exists within the vault system, it cannot automatically be used to settle futures contracts unless the owners decide to convert it into registered status. This distinction is important. Because when traders begin requesting delivery, the exchange relies primarily on registered silver inventories to meet those obligations. If registered inventories begin declining while delivery demand increases, the balance between paper contracts and deliverable metal becomes more sensitive. Historically, there have been periods when analysts closely monitored these inventory levels because they appeared unusually tight relative to the number of contracts outstanding. These moments often generate speculation about the possibility of a squeeze. A squeeze occurs when participants who have sold contracts short are forced to acquire physical metal or buy back their contracts because delivery demand exceeds expectations. If multiple traders attempt to secure metal at the same time while inventories remain limited, prices can move quickly. This does not happen frequently, but when it does, the impact can be dramatic. And this is where rule changes like the recent CME margin adjustment begin to intersect with the physical market. When margin hikes force leveraged traders to exit positions, the structure of the futures market changes. Some contracts disappear as traders close positions. Others may remain as participants reassess their exposure. If the number of outstanding contracts shrinks while physical demand continues increasing, the balance between paper claims and physical metal can begin shifting. This does not automatically create a squeeze, but it changes the conditions under which one could occur, because the silver market is unique in that it serves two very different roles simultaneously. It is both a critical industrial material and a monetary metal that investors turn to during periods of economic uncertainty. Industrial demand tends to remain steady because manufacturers need silver regardless of short-term price fluctuations. Investment demand, on the other hand, can surge rapidly when investors begin seeking alternatives to financial assets. If those two forms of demand ever begin rising at the same time while supply remains constrained, the pressure inside the silver market could increase quickly. And when that pressure interacts with the leverage embedded in the futures market, the potential for large price movements becomes much greater. Which brings us to the most important question investors are asking right now. If the CME is tightening rules, leverage is being reduced, and physical demand remains strong, what would actually trigger a full silver squeeze? So what would actually trigger a true silver squeeze? Because that is the question investors keep asking whenever the CME changes the rules. The answer is not a single event. A squeeze usually happens when several pressures inside the market begin interacting at the same time. First, physical demand must remain strong. Industrial users, investors, and manufacturers need to keep pulling silver out of the supply chain. If real metal continues leaving the market faster than it is replaced, inventories gradually tighten. Second, leverage inside the futures market must begin shrinking. Margin hikes, like the one the CME has just implemented, do exactly that. By forcing traders to post more capital, the exchange reduces the amount of leveraged exposure circulating in the system. Some positions disappear entirely as traders are forced to close them. Third, the balance between short sellers and buyers must shift. If too many traders are positioned for falling prices while physical demand remains strong, rising prices can create pressure on those short positions. As losses increase, short sellers may rush to exit their trades by buying contracts back. That buying pushes prices even higher, and that is the moment when a squeeze can begin feeding on itself. Prices rise not just because of new buyers entering the market, but because existing short positions are forced to unwind. Now combine that dynamic with a tightening physical supply chain. If investors begin requesting delivery while inventories remain limited, the financial market can suddenly be forced to reconcile with the physical reality underneath it. This is why rule changes from institutions like the CME always attract attention in the silver market. They do not create squeezes by themselves, but they change the structure of the system where squeezes become possible. And if the pressure building beneath the surface of the silver market continues increasing, the next major move may not come gradually, it may come all at once.